If this corridor stays shut, oil doesn't just rise, it explodes. And if oil explodes, inflation comes back, rate cuts disappear, and markets reprice faster than most investors expect. This is not just another Middle East headline. This is about one of the most important energy choke points on Earth, the Strait of Hormuz. A narrow strip of water that most Americans couldn't point to on a map, but that moves a massive share of the world's oil and natural gas. And right now, the market is being forced to ask a brutal question. What happens if a regional conflict turns into a global energy shock? Because when energy gets disrupted, everything else follows. Gas prices, inflation, interest rates, stock market valuations. And if you want to understand what Wall Street is watching right now, you actually only need to watch two things: oil and natural gas. Everything else is noise. Let's zoom out for a second. The Strait of Hormuz is only about 21 miles wide at its narrowest point, but it's one of the most critical arteries of the global economy. Roughly a fifth of the world's oil supply moves through that corridor. On top of that, a huge portion of global liquefied natural gas shipments also pass through the same area. That means when tensions rise there, the problem isn't just military, it becomes economic. Because energy sits at the base of the entire system. Oil powers transportation, it drives logistics. It affects manufacturing costs. It impacts agriculture, fertilizers, and food distribution. And when oil spikes, inflation follows. There's a simple rule in macroeconomics. Higher energy costs ripple through the entire economy. That's why energy shocks have historically been some of the most powerful triggers for inflation spikes. And right now, markets are starting to worry that we could be entering exactly that kind of environment again. Here's why investors are paying attention. In the last few days, oil prices have surged dramatically. And that move matters not just for energy companies, but for the entire financial system. Because higher oil prices change expectations for the Federal Reserve. If energy prices push inflation higher, the Fed has less room to cut rates. And if rate cuts get delayed, the entire valuation structure of the stock market shifts. Suddenly, growth stocks look more expensive, borrowing becomes more costly, and financial conditions tighten. That's the transmission mechanism. Energy feeds inflation. Inflation feeds interest rates. Interest rates feed asset prices. If you understand that chain reaction, you understand why Wall Street suddenly cares about what's happening thousands of miles away. But there's another piece of the story that doesn't get talked about enough: shipping. When geopolitical risk rises in a critical trade corridor, insurance premiums explode. Shipping companies reroute vessels. Cargo gets delayed, airlines suspend routes, and suddenly the cost of moving goods across the world jumps dramatically. That creates another layer of inflation pressure, not just from energy itself, but from the cost of transportation. Imagine a cargo ship that used to cost $8 million to move goods across the ocean. Now suddenly it costs 3 or 4 times more because of risk and insurance. Those costs don't disappear, they get passed through the system. Companies pay more, consumers pay more, margins shrink, prices rise. Now here's where things get really interesting for US investors. In moments of global stress, money tends to move toward what investors believe are safe assets. Historically, that meant treasuries, gold, and sometimes the Swiss franc. But in many modern crises, something else happens. Capital rushes into the US dollar. Not necessarily because the US economy is perfect, but because the dollar is still the most liquid asset in the world. When uncertainty rises, investors want liquidity first. And right now, you can see that dynamic starting to play out. The dollar has been strengthening relative to many major currencies. And that tells you something important. Global capital is getting cautious. Meanwhile, different sectors of the market are reacting in very different ways. Energy stocks obviously benefit from higher oil prices. Defense companies often see increased demand during geopolitical crises. But sectors heavily exposed to fuel costs, like airlines and transportation, start to feel pressure. Airlines in particular are extremely sensitive to fuel prices. Jet fuel is one of their largest costs. So when oil spikes, airline stocks often struggle. Shipping companies face similar problems if insurance costs surge. This is why market reactions in environments like this often look chaotic. It's not random, it's rotation. Capital moving from vulnerable sectors into more resilient ones. There's another macro risk that investors are starting to whisper about: stagflation. It's one of the most uncomfortable economic scenarios possible. It happens when inflation rises while economic growth slows, and energy shocks are one of the most common triggers. Higher fuel costs squeeze consumers. Businesses face higher operating expenses. Growth slows, but inflation remains elevated. That combination puts central banks in an impossible position. If they cut rates, they risk fueling inflation. If they keep rates high, they risk slowing the economy further. Markets hate that scenario because it creates policy uncertainty, and uncertainty is one of the most powerful drivers of volatility. Now, none of this guarantees that we're heading into a full-blown crisis. Financial markets often overshoot when uncertainty spikes. If tensions ease and energy flows normalize quickly, oil prices could stabilize and markets could recover just as fast. That happens all the time. But what markets are doing right now is adjusting probabilities. Investors are asking themselves a simple question: what if this lasts longer than expected? Because if disruptions in energy supply continue, the ripple effects could be significant. Inflation could rise, rate cuts could be delayed, and sectors across the market could start repricing risk. So if you want to monitor this situation like a professional investor, focus on the indicators that actually matter. Watch crude oil futures, watch natural gas prices, watch treasury yields, watch the dollar, and watch how different sectors of the stock market respond. Energy stocks, transportation, airlines, defense. Those moves will tell you far more than any headline, because markets don't trade on stories, they trade on consequences. The key question right now is simple: will energy flows through the Strait of Hormuz remain stable? If they do, this could end up being a temporary volatility spike. But if disruptions continue, we could be looking at a genuine global energy shock. And when energy shocks happen, they rarely stay contained. They spread through inflation, interest rates, and asset prices faster than most investors expect. Which is exactly why Wall Street is watching this situation so closely right now. Because sometimes the biggest risks in global markets don't come from complicated financial models. They come from a narrow stretch of water halfway around the world. See you in the next deep dive.